So good to have you join us today. Hello and welcome to Business Daily. I'm Ji-yoon in Seoul. Before we get started, let's first get a quick check of today's highlights. The U.S. Federal Reserve raises rates for the first time this year and signals a faster pace of increase next year as the country gets ready for new policies under the Trump administration. On the other side of the globe, the Bank of Korea freezes its rate at a record low of 1.25% as political and economic uncertainties continue to threaten the local economy. We have these stories and more coming right up. No surprises here. As widely anticipated, the U.S. Fed Reserve has raised its key interest rate for just the second time in more than 10 years. The big question now is what comes next year? Our Eunice Kim starts us off.
The U.S. Federal Reserve has raised its benchmark interest rate by 25 basis points to between 0.5% and 0.75%. The last increase was in December of last year from a record low near zero set during the 2008 financial crisis. The Federal Open Market Committee voted unanimously for the hike, citing a stronger U.S. economy, better jobs reports, and inflation nearing its 2% target.
Over the past year, 2.25 million net new jobs have been created. Unemployment has fallen further, and inflation has moved closer to our longer-run goal of 2%.
Chair Janet Yellen also said there would only need to be gradual increases in the future, based on the Fed's expectations for the economy.
We continue to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain our objectives.
Left out of the official statement was Donald Trump. During the Q&A, Yellen downplayed expectations that Trump's expansionary fiscal policies will fuel inflation and lead to faster rate hikes. But she did indicate that Trump's impact on U.S. tax and spending policies might have influenced some of her colleagues' forecasts for next year. The Fed sees 3 rate hikes next year instead of the 2 foreseen in September, which Yellen says will be modest adjustments driven by growth of the U.S. economy and a more buoyant jobs market. By the end of 2017, the key rate is projected to reach 1.4%, 2.1% the year after, and 2.9% by 2019. In reaction to the widely expected news, Wall Street was mostly down, but not by much. The Dow Jones Industrial Average lost about 0.6%, the Nasdaq slid 0.5%, and the S&P 500 fell 0.8%. The dollar index rose more than 1% against a basket of major currencies, hitting its highest level in nearly 14 years. Eunice Kim, Business Daily.
And shortly after the U.S. Fed Reserve's rate hike announcement, Korea's central bank also released its monthly rate decision. Here's our Shin Se-min with more.
Korea's central bank ends the year by leaving its key rate steady at an all-time low of 1.25% for December on the heels of the U.S. Fed's rate hike. With this, the BOK has kept its rate untouched for a full half year.
We're keeping a close eye on the pace of the Fed rates increases. If advanced economies start tightening at a faster pace, it would definitely lead to instability in emerging markets. So we need to watch closely to see whether it will trigger financial instability there as well. This would be a major risk factor.
The top central banker added that eyes are also on whether the incoming Trump administration will fulfill its campaign pledges, as it could influence the Fed's rate hike scenario for next year. The Fed's rate lift puts Korea's central bank in a more difficult position as it's faced either with the option of also raising rates to reduce risks of capital outflows or continuing with its trend of low rates to buy time for the country's skyrocketing household debt while propping up consumer spending.
Market expectations on the BOK's next move are mixed, as some believe that the central bank should keep up with the Fed's rate hike pace. while others worry that a hike would only worsen the current economic conditions, like the mounting household debt.
Toning down concerns of a potential mass capital flight, Governor Lee Ju-yeol also said he doesn't believe the U.S. rate hike would lead to an abrupt outflow from the local market, considering the country's solid economic fundamentals. The top central banker added that looking ahead, the BOK will maintain its monetary easing measures to help prop up the economy while ensuring that the financial markets remain stable. Shin Se-min, Business Daily.
So the U.S. Fed has finally pulled the trigger on rates, while the Bank of Korea has decided to stand pat. To tell us more about this, Professor Yang Jun-seok from the Catholic University of Korea joins us in the studio today. Great to have you here.
Happy to be here.
All right, so what could be some of the biggest reasons behind these decisions from the U.S. and the BOK?
Well, for the United States, they've been getting very close to full employment rate for a long time. The last unemployment rate that they released in November was 4.6%, which some people consider below full employment rate. So their employment rate is going very well. And then their core inflation rate, inflation without the oil and fresh food prices, have been hitting 2% or slightly higher, which is above their goal. Now, what has hindered Fed's decision in the past is that while they have a very close to full employment rate, the labor force participation rate was lower than before the global financial crisis, and not the core inflation rate, but the consumer price index inflation rate was below the target of 2% because of the oil prices, but partially because the U.S. recovery has been steady, partially because there's been sort of a Trump euphoria, and partially because OPEC has decided to try to raise their prices. I think they decided that it's now time for a rate increase. Now for Korea is sort of stuck in a vice. It cannot lower its rates because we have a lot of household debt, and the United States has raised its rates, but Bank of Korea cannot raise its rates either because the economy is in such a weak position. So I think they decided to stick with the rate for now, see what happens, which I think actually is a prudent decision.
All right, well, and although the rate decision was an expected one in the U.S., the FOMC members also suggested the potential for 3 potential rate increases for next year. Tell us more about this.
Right. Now, we should not put too much faith on this because they always overstated the amount of rate increases that they would have in the last few years.
Right.
But what makes it sort of different this time is that the recovery does seem to be steady, and there's Trump euphoria going on, even though Janet Yellen didn't seem to have too much faith in it. So if this continues, then they might actually go through with the 3 rate cuts. And what makes this particularly different for Korea is that if they do actually go through with those 3 cuts, and Bank of Korea does not raise its own rates, then the United States will have a higher policy rate than Korea. Now, policy rate is not exactly the same thing as actual lending rates, so there's some wiggle room there. But given that the Korea is more risky investment than the United States, if the United States has a higher rate, then that means that it's virtually impossible for Korea to maintain a stable capital market.
Then with all that in mind, what can we expect next year from the BOK?
Okay, well, BOK, depending on how quickly the Fed raises its rates, the BOK will have to raise its rates so that it'll have to keep the rates higher than the United States. Now, that will probably bring problems within the Korean domestic economy, but right now I don't see any way to get around it. Hopefully, we'll have some expansionary fiscal policy so that it'll mitigate some of the effects from the interest rate increase, but that presumes that the political team gets its act together, or the rate increases come really late at the year after the presidential elections in Korea.
Now, some are actually saying that the BOK should even further lower the interest rate from right now a record low of 1.25%, taking into account all the uncertainties, political and economic uncertainties faced by Korea. So what are your thoughts on this?
Okay, well, if this were normal times, then I would probably agree. The macroeconomic variables, well, they're not too bad, but they're not too great either. And because of the political turmoil, I think under normal circumstances, it calls for a rate cut. But the problem is these are not normal times, and the last 2 or 3 rate cuts did not do very much good. Now, if Bank of Korea does lower its rates, then I think they'll have to raise it very quickly, especially if the Fed decides to raise their own rates. So I think we should look at how the markets react to the smaller differential between the Korean and U.S. rates. And if the capital outflow isn't that bad, then there might be a wriggle room for another rate cut. But I'm not sure if that would do that much good at this point. I would much more prefer a fiscal policy rather than monetary.
Now, by continuing to lift rates from near zero, the U.S. Fed is perhaps slowly ending the era of unprecedented monetary policy support and also giving the economy room to advance without it. So would you see this trend spread further to other countries from here on out?
Okay, I would put a bit of a qualification on this. For the major countries which have major currencies of their own, I think they will continue the 0% rate. Japan has said that they will keep their rates lower for a longer time. Probably same thing with Eurozone, though. They're expressing more skepticism. So for those 2 areas, at least until their economy recovers, I think they will stick with the 0% rate. But for the other countries which do not have a major currency, they cannot help but be affected by the United States rates. So for those countries, I think we'll see an increase in interest rates.
Now, what kind of measures does Korea need to put out then to respond to changes coming from the U.S. as well as within Korea?
Okay, well, as I mentioned before, I think first of all, we have to get the politics and the economic policy team get their act together. I think the Vice Minister Yuiro should clarify what his goals and strategies are. He's done part of this already, but having the goals and strategies spelled out transparently will help, I think, resist the temporary political influences that the politicians are going to have.
Right.
And then if we're really worried about household debt, then I think we should consider strengthening the DTI, LTV, and the debt service ratio regulations, which they should have done in the first place. So rather than trying to control it through monetary policy and interest rates, do it through the regulations, which were designed to do that in the first place.
All right. Thank you so much for your insight today, Professor.
Thank you.
Let's now get a check on how the markets fared here in Seoul today. Korea's benchmark index closed mostly flat on Thursday, followed by losses overnight on Wall Street after the U.S. Fed Reserve raised its key interest rate. The Kospi closed at 2,036.65, down just 0.01%, while the tech-heavy Kosdaq continued its upward trend, climbing 1.3%. On the foreign exchange counter, the local currency weakened by nearly 9 won, trading at 1,178 won against the greenback. Korean exporters are increasingly finding themselves the target of non-tariff measures by foreign countries. According to the Korea Chamber of Commerce and Industry, non-tariff measures stood at 134 between 2012 and 2016, up from 65 between 2008 and 2012. Non-tariff measures, which include anti-dumping duties, refer to obstacles which are not import or export taxes and impede trade. On a global level, the number of cases has been on a downward trend. During the cited period, non-tariff measures around the world came to 4,652, down almost 4%. By country, the U.S. topped the list of non-tariff measures against Korea with 24, followed by India and Australia. Korean companies have seen their biggest third-quarter sales drop in 13 years. According to data by the Bank of Korea on Thursday, companies saw sales plunge 4.8% from the year before. Now, that's the biggest slide since the third quarter of 2003, when numbers plummeted 6.3%. The central bank pointed to low oil prices and Samsung Electronics' Galaxy Note 7 fiasco. Sales in the manufacturing industry fell 6.1%. The electronics sector saw a decline of 7.4%, and the petrochemicals industry slid 6.4%. Samsung Display is increasing its presence in the small and medium-sized display market. According to market researcher IHS Markit, the Korean company posted sales of nearly $3.7 billion in the third quarter. It accounts for almost a third of the market for displays under 9-inch, which are usually used for smartphones or wearable devices. It has maintained a market share in the 30% range since the first quarter. And Japan Display was the second biggest player, followed by Korea's LG Display. Samsung Display's dominance can also be seen in the flexible OLED displays, making up a whopping 96% of the market. The company topped the $1 billion mark for sales for the first time in the third quarter, and the figure is up almost 70% from a year ago. And that wraps it up for today. But we'll be back tomorrow with more at the same time, same place for your Business Daily. So don't forget to tune in then. Thanks for watching and see you soon.